Thanks for clicking. The Bank of Canada could cut interest rates by 200 or 300 basis points due to the looming Canadian debt crisis. This according to David Rosenberg and Ed Devlin during an interview with Bloomberg on Tuesday. And the reason for the substantial rate cuts, according to Rosenberg and Devlin, is the near record levels of Canadian debt and the amount being spent to service it.
It was this high just before the 2000 recession. It was this high before the 2008 recession. It's actually higher today than it was back in 1990.
Indeed, as we'll see later, Canadian debt levels are at a near all-time high. However, as we'll see later, and if you consult with any bank, just because you borrow too much money doesn't necessarily mean you get to borrow more cheaper.
I did maybe think that I that up, wasn't sure.
So what I want to do today is go over Bloomberg's interview with Rosenberg and Devlin, take a look at the state of Canadian household debt, especially relative to that of the US, discuss the options available if Rosenberg and Devlin are correct, and then go over what to look for next. As we'll see, as mentioned in the interview, it was announced on Tuesday that Scotiabank is putting away $1.3 billion for loan loss reserves, obviously preparing for a potential downturn in the real estate market. We are eagerly awaiting the release of November's real estate data from the local boards, set to be out in the next couple of days to a week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. On to the interview. As mentioned, Rosenberg and Devlin are predicting that the bank will have to cut rates by 200 to 300 basis points over the next cycle, with 100 to 200 and rate cuts coming in the next year alone.
You know, I would think 100, 200 basis points next year is pretty realistic.
But I think this cycle will see at least 300 basis points.
And the reason, says Rosenberg, is not just the current level of debt held by Canadians, but also the growing cost of servicing that debt.
And we have a situation today where the debt-to-income ratio in the household sector is over 170%. I mean, it's 35 percentage points higher than it was at the credit bubble peak in the United States back when I was pounding my fist on the table at Mother Merrill about how this is not going to end well.
And yeah, he's not wrong. In 2007, right before the financial crisis, U.S. household debt servicing costs were sitting at 13.1%. compared with a recent RBC estimate of 15.5% here in Canada by the fourth quarter of 2024.
In aggregate, almost 15% of Canadian personal income is being siphoned off into servicing the debt.
However, in the aftermath of 2008, while the US deleveraged, bringing down its debt servicing costs, Canadians continued to increase their debt, bringing our debt-to-income ratio close to the 170% that it is right now.
Completely normal.
And, according to Rosenberg, the cost of servicing that debt is creating the potential for defaults, for which banks like Scotiabank are preparing.
You're talking, I mean, you can carry 170% debt GDP at zero rates, but you can't carry it at a 5% overnight rate. And so there's a big difference. So really what's happening here, this is what's creating the defaults and the delinquencies and the fact that banks had to put more loan loss provisioning.
And here's where we get to the crux of the problem. If the Bank of Canada is going to have to cut rates due to the high levels of Canadian debt, does it do so before those defaults pile up, or does it do so after?
Why can't we do both?
And even Bloomberg thought to delve a little deeper, asking Rosenberg and Devlin if the bank cuts too early, doesn't that risk sending inflation and the housing market back upward?
Think about the intangibles of inflation. If all of a sudden the messaging changes and people are out there and, you know, willing to go out and jump into the housing market again, are there not inflationary concerns that come if the messaging changes from the Bank of Canada? For
his part, Rosenberg didn't seem to think it was going to be a problem.
I think that it's going to be highly unlikely that at a time when Canadians are so debt constrained that they're going to actually be taking on a lot more debt.
Yeah. Where the are you?
Yeah, if we look back at the data, that certainly wasn't the case in the spring, following the Bank of Canada's rate pause, and the benchmark price of a home increased by $46,000 between March and August. So, it's not clear, right now at least, under current economic conditions, that the 100 to 200 basis points in rate cuts being predicted by Rosenberg and Devlin won't lead to a reinflation of the Canadian housing market. Now, I should note that Rosenberg does say that with the impending defaults, banks are going to be tightening lending standards, which should keep a lid on prices.
And you start off with the Bank of Nova Scotia. What are the banks going to be doing? The banks are increasing their loans provisioning, which means what? It means that credit standards are going to tighten. It means the availability of loans, including mortgages, is going to be restricted going forward. So the view that, oh, they're going to cut rates and it's going to lead to this influx of demand for housing, that'll happen a couple of years from now. That is not on the horizon.
I don't know what to root for.
So the argument is that the Bank of Canada is going to loosen by 200 basis points and the banks aren't going to follow suit. They're not going to follow suit on insured loans that are backstopped by the government. I don't really buy this, and I don't think the Bank of Canada does either. So, is the Bank of Canada going to take that risk? Is the bank going to risk sending the real estate market surging back upwards and inflation with it? Central banks lower rates to provide stimulus to the economy that is not spending, to get people spending who wouldn't be doing it otherwise.
That worked out.
But, let's be clear, U.S. households got those rate cuts not because they had racked up too much debt and couldn't service it. They got those rate cuts due to the massive recession that almost took down the global economy. The U.S. saw its unemployment rate spiking to 9.9%, and its average house price dropped by 17% during that recession. And this leads to the choices facing the Bank of Canada in 2024. Does the Canadian economy have to get as bad as the U.S. was in 2008 to deliver those rate cuts? Or, if the bank doesn't wait for that recession, doesn't wait for those defaults, doesn't it risk re-accelerating the housing market? Doesn't it risk re-accelerating prices? The only other time over the past 20 years that we've gotten as drastic of rate cuts as being spoken about by Rosenberg and Devlin, rate cuts exceeding 150 basis points in a single year, was in 2020, 2008, and after the dot-com bust. All emergency rate cuts. And remember, when we got those rate cuts, inflation hadn't been north of 3% since 1992. So, we have Rosenberg and Devlin predicting 100 to 200 basis points worth of rate hikes over the next year, 300 over the next cycle. Yet, when we look back at the data, when we look back at history, we can see that Canada doesn't get that level of rate cuts without seeing some economic pain, without seeing major economic pain, much more pain than we're seeing right now. The last time, except 2020, that the Bank of Canada cut rates that quickly, Canada's unemployment rate was on its way to hitting 8.8%, but right now is currently sitting at 5.7%. If the bank is going to want to see damage before providing those 100, 200, 300 basis points worth of rate cuts, we certainly have a long way to go. With that said, pressures are growing on the real estate market, on the economy, and news from Scotiabank seems to bear that out. How long the Bank of Canada will allow those pressures to grow remains to be seen, but we'll obviously continue to track the bank's progress on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.